So let's bring in our next guest. It's going to be Alan Nuckman. He's Chief Market Strategist at BullseyeOption.com. Alan, welcome back to the show. We got some data popping right now. I wanted to get your initial reaction. Initial jobless claims coming in a little bit, basically in line, about 233,000 versus 238,000 expected at this point. Give me your take here on jobless claims first, because I think the jobs market's most important to the Fed at this point.
Well, it's most important to everybody. I mean, since I was a young trader, that's what we focus on. Once a month, that was the big deal. That's what gave us a gauge of how strong the economy was or weak. And so, I listened to what you said, with the last segment, and I somewhat agree that, a tiny uptick could give the Fed what they need to get a little bit more aggressive cutting rates. It's not a matter of if, it's a matter of when they're going to cut rates. And I think it all comes back to the dollar. That's what we can discuss here this morning.
Yeah, continuing claims, 1.839 million on that one versus 1.828 million. Last estimate was about what we saw last time. But if you look at, maybe that jobs market, Al, and if you start getting, 4.2%, 4.3%,
right,
this jobless claims maybe up to 250 a week, because it doesn't seem like the job market's as robust as it was. But, the economy's humming along. Can the Fed navigate, this soft landing that everybody wants them to?
Well, and so far they absolutely positively have. I mean, this has been a perfect result. If you're results driven, if you're ideology driven, no. But if you're results driven, the answer is yes. The stock market is, at all-time highs. We've got the VIX down. We've got inflation down. We've got rates moving down. And, if you look at the 10-year note yield, that's driven by supply and demand. That's not driven by the Fed. And we've seen it relax. To get back to the dollar, because I think that's really the key for commodities and stocks here in the near term, the dollar is not high. The dollar is at the high end of a 2-year range. We've been between 100 and 106 for 2 years. We were at 115 in 2022. So put that in perspective. We're not going down, but we're not going higher. We're just drifting, and we're at the high end of the range right now. So if you look at commodities, and that's what this segment is, that's what this show is, we're in an everything bull market, and the next catalyst could be if the dollar stops going, stops holding here and moves down at all. That's very, very bullish for every asset class, stocks and commodity.
Now, what happens here on the other side, the flip side, Alan, because if you look at some of the central bank intervention overseas, Japan, they're probably going to have to do something with their currency, which didn't work last time. If we continue to see pressure from overseas, maybe their weakening economy that props up our dollar a little bit more. What if the dollar, what I pose that to Luke Gromen is, what if the dollar goes to 107? He's like, that's not good for equities.
106. We were at 115. The high in the dollar is 120. If you go back to when I started trading, 1986 is when I graduated high school. So, if you go back, the dollar's been between 120 and 80 for however many years that is. That's a long time, okay? And so that the midpoint is 100. We're sitting at 105. For us to go to 105, 106, 107, that's minutia. That's not a spike. But again, it's most important, not what I think or what you think, is how the markets react. Right. And the fact is the stock market's made new highs, how many times? 37 times or something so far this year, with the dollar holding at these levels. I'm just saying that if it stops holding these levels and drifts lower, that's the big catalyst.
I think, Alan, I think it's going up to 107. I think you think it's going to crack and help support the equity markets at this point. And you
but
said
107 doesn't hurt. 107 doesn't hurt anything. 107 doesn't hurt anything. 107 from 106 to 107. That's nothing. If we go to 120, yeah. But if we go to 107, I don't think that does anything.
See, you don't think it does anything, but when I look at a comparison chart, when, the last time the dollar was at 106, the equity market was 10% below here. So when I see equity markets getting stretched on a technical basis, on a valuation basis, a forward-looking 21 PE, that's when I start saying it matters, and everything's become more global since we started trading on the floors years ago.
Well, that's a broad brush, but what I would say is go look at risk reward. And I know you talked about how we're stretched, and yeah, we could get a profit-taking pullback at any time. The Nasdaq's up 7% off its low. The S&P's up 55% off its low. So, of course, there could be a pullback to profit taking. But the trends are strong, and you can't mess with the physics of the momentum. There will be pullbacks. The last pullback, we had the NDX down 10%. Everybody bought in. We had the S&P down 5%. Everybody bought in, rallied to new highs. So I focus on risk reward. And risk reward right now is in the resources and commodity stocks. They have much lower PEs. They haven't participated. And a lot of them, if you look at GDX, the gold miners, it's half of its all-time highs. If you look at silver, it's not even half of its all-time high if you adjust for inflation. So there's a lot of upside. If you look at energy stocks, the PE of XLE is at 8. So, the energy stocks are where I think the potential is. If we break out here, we break out with crude oil above 85, then those energy stocks are going to rip and roar, and they've been undervalued and underplayed. Yeah, and you mentioned that, that I looked at a chart earlier in the show, S&P 500 equal weight, which is really lagging, down, not even up 4% this year. And then you've got the S&P 500 up nearly 15%. So that gap is widened. Which one plays catch up? Is it the equal weight, or does the S&P 500 fall? But I want to kind of expand on that real quick here, Alan, about the oil markets, because a lot of that CPI data that was a little bit weaker than expected last month was based on the fact that energy prices fell. But now we've got crude oil back near 81 bucks a barrel. I'm hearing demand concerns, but at the same time, it's still moving higher, Alan. I know Ben's not here, so you're doing a great job of throwing out the buts. So the market is strong, but if you look at crude oil, and I just can go back to prints and charts, and you have to do the same thing. Go back to 2011 to 2013. Crude oil was at $100 a barrel and above that whole time, and the S&P rallied 33%. So the reality for me a lot of times is that crude oil at $85 is still half. Let me say this again, half of what it was if you take the 2008 high and adjust for inflation. So we're nowhere near where we were. So it's not a concern, and I look at it as a positive side. You've got people traveling. The biggest travel day in airline history was just last week. You've got people moving, and the demand is increasing, and people are doing what they want. So I look at that as a positive when you see crude oil pick up like that. Yeah, it might affect some of those inflationary data points, but at the same time, it may be a sign of a healthy economy, which may also be a positive for equities also. All right, great stuff, Alan. Love the discussion. Optimism wins. Yes. Optimism wins. It always does. The market always does that. Appreciate you, Alan. Have a great day. That's Alan Nuckman, Chief Market Strategist at BullseyeOption.com.